Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we're going to learn a concept which is known as marketable securities on the balance sheet, and we're going to understand some of the top examples. As we move down, there's extract taken and there's a thing mentioned over here. The marketable securities is nothing but a financial instrument that can be bought or sold easily. So it's a buy and sell you can do in a very quick fashion. These securities are very important investment class and are favorites of the major corporates, the blue chip companies. The Microsoft has more than 50% of its total assets as the short-term investments or the marketable securities. Now the question over here is why? 50%. My goodness, look at see the number here. The 193,694 is the total assets, and of that 106,730 it just falls in the short-term securities. So that's a big number in itself here. That is in the current assets part. Let's understand why Microsoft is doing this. There must be some reason behind this. They must be having some logic. Let's understand that. Now, what are the marketable securities? That is the first and the foremost thing that we need to understand. Marketable securities, as we understood, is the financial instrument that can be easily be bought and sold on the stock exchange with a short period of time. So in order to understand the definition, we first need to understand one important term in the above definition, what I just quoted, is the financial instrument part. So the financial instrument basically represents a legal obligation to pay or receive any monetary value. So financial instruments are the assets that can be exchanged or traded. Second, some of the common types of financial instruments are like equity shares, we have preference shares, debts, derivatives. So these securities are the part of the financial instruments, and all the marketable securities are the financial instrument, but all financial instruments are not marketable securities. Remember that. Now, what are some of the features of the or you can say the traits of marketable securities? See, well, there are many features of this security, but the two most important ones that set them apart from the rest are as follow. The marketable securities on the balance sheet, they are highly liquid. Okay, this is perhaps the single most important feature that every financial instrument must have in order to classify them as the marketable securities. So these securities, they are highly liquid and can be easily be converted into cash within a very short time span and at a reasonable price. What amounts to the short time has not defined anyway, but as per the conventional conventions and the generally accepted principles, the duration should be closely to less than 1 year. Now, some of the examples of the instruments who exhibits features and hence it is classified as marketable securities are like commercial paper, CP, the treasury bills, the bills receivable, and other short-term instruments. Right. Now, second important feature is that marketable security are easily transferable. Now, in order to be liquid, the security should be easily be transferable and highly liquid. Okay. An easily transferable feature of these securities are complementary to each other. So such securities are instruments that can be easily be transferable on the stock exchange, some other exchanges where this are been traded. So the above two feature, the transferable and highly liquid, is used to classify any security as the marketable security. Now, let's understand how this is used as the classification tool with the help of the practical illustration. Let's say there is this company X which invests in US Treasury, invests in US Treasury bonds, okay, having a maturity, let's say standing at 30 years in the financial year 2016. Okay, the company's financial controller, let's say Mr. Adam, he's basically in the dilemma as to whether those investments are to be classified as securities or not. So what we discussed, based on that, the classification of the securities as marketable securities has to be judged based on two important factors. What we learned, highly liquid and easily transferable. So classification of such securities are not based on the time duration for which it is held by the investor. So the marketable securities on the balance sheet can be long term or it can be short term, right? It can be two things, long term or short term. So the government security generally have a long term, you can say they have long term duration. Like for example, the US treasury maturity can be as high as 30 years and as low as 28 days. So you cannot judge based on that. Government security are one of the most preferred mode of investments used by many Fortune 500 companies. Even though the securities don't promise to return the principal back to the investor for 30 years, they can be sold relatively quickly in the bond market, and hence they are highly liquid and easily transferable. So thus they are classified as the marketable securities, right? The third feature is that the third thing is that the lower return on marketable securities. So return on the security is directly proportional to the risk associated with. Higher the risk, that means higher the return. Now, since the securities are highly liquid and easily transferable, inflation and default risk associated with them are very low. Inflation and the other one is the default risk, they are very low. So because of that, associated with them, they are very low in comparison with what type of other securities. So investor has to make a trade-off. This is a very important word. Trade-off between the risk and the returns when choosing them, the securities. Right. So different types of risk that are associated are something like this. The first one is the default risk. Now, the default risk is the probability that the issuer or the borrower will be able to make payment on their debt obligation on the due dates. The second is the interest rate risk. Right. So interest rate risk is the risk associated with the fixed return instruments like bonds, debentures, whose value decreases on account of rising in the interest rate. Third is the inflation risk. Now, unlike other risk that affects only the fixed income instruments like the interest rate risk, inflation risk affects all the type of securities because it affects every economy. Its effect is seen more in high inflationary economy where price level of the commodity rises drastically every year, and the rise in the price level reduces the value of the money, and decreases the value of the money results in decrease in the return on the assets. Now the fourth part, the marketability of this securities. Now, marketable securities have an active marketplace where it can be bought and sold, like the London Stock Exchange, then NYSE, that is the New York Stock Exchange, and so on and so forth. So marketability is similar to liquidity, except that the liquidity means that the time frame within which the security can be converted into cash, where the marketability implies that it implies the ease with the securities can be bought and sold. So on the concluding end, all the above features and of the marketable securities on the balance sheet have made them quite popular means of financial instrument. Almost every company holds some amount of marketable securities. The specific reason for holding that depends on greatly on the solvency and the financial condition of the company. Despite many advantages, there are some limitations, like low returns, default risk, inflation risk, associated with they are connected with the marketable securities. So marketable securities are held by the company for trading purpose or liquidity purpose. Generally, these are held up to their maturity period, but the company may sell them prior to their stated maturity for some strategic reasons, including but not limited to anticipation of credit deterioration or duration management. Thank you everyone for joining the session. Cheers.